Hello, I'm Mark Bolton. Now, I know that LinkedIn is not Facebook. However, I am going to deal with something that's got a little bit of politics involved today, and I wouldn't normally do this, and I promise I won't do it again. But back in April of 2015, I wrote an article called FATCA, CRS and the Law of Unintended Consequence. If you read that article or will read that article, you will note that at the end I mentioned that the US is becoming a tax haven, and hence we end up in the world of politics. Now, the big issue for the last few years has been around tax collection, tax compliance by governments. In my view, people should be allowed to arrange their affairs so that they pay the minimum legal amount of tax necessary. And I'm very sympathetic to business people and entrepreneurs who built either a career or a business can end up paying 50, 60, even 70 or 80% tax at the margins. If I was in charge, which I'm clearly not, but if I were, then we'd have a flat tax. All countries would work off the same flat tax basis. There will be no competition. There will be no loopholes whatsoever, which disproportionately benefit the super rich. And there would be a very large tax-free allowance that enabled people in the lowest incomes to keep the vast majority, if not all, of the income that they earned. In many respects, it will be at least as progressive or more progressive than our current super complex, convoluted systems, and it would therefore be fair. It would therefore be very simple. It would also be effective. However, until then, global reality prevails. And that means that we live in a world of tax competition between nation states. We live in a world of dual taxation treaties, of tax compliance issues, and of course large law and accounting firms who have an interest in keeping the system as opaque and complex as possible. Now, if you have been away from planet Earth for the last few years, a quick recap on what's been happening. In San Bernardino County, a patch of scrubby desert to the east of Los Angeles, many houses started to get built in the mid-1990s through to the mid-2000s. This was to enable young couples, typically young couples, who were priced out the metropolitan Los Angeles market to buy their first home, to breed, to own a dog, to park their SUV, and to commute into Los Angeles for work. All was well. The banks were happy to lend in a rising market. The banks were able to, as soon as they'd issued a mortgage, turn around and sell that mortgage to Wall Street. So they took the risk off and then turn right round again and sell another mortgage. They were therefore less than particular about the lending standards that they needed to adhere to. Meanwhile, the potential homeowner was happy just to be able to get a mortgage and get into their own house and move out of that small rented unit that they were in East LA. So everything worked fine. However, in 2005-2006, rising prices of the property started to stall, and people started to default on their mortgages. They could no longer make mortgage payments because the recession started to bite, and suddenly the banks were faced with foreclosing on large numbers of properties. This contagion spread throughout California and then across the US and ultimately engulfed the world in what's become known as the Great Recession. Initially, just banks that were busy lending into those marketplaces were impacted, but as the contagion spread in the home market, it also spread in the banking market. And Wall Street banks in particular that had sold those CDOs, collateralized debt obligations, into other parties also started to feel illiquidity issues and credit issues between the banks, who no longer knew who they could trust and who they could not trust. All of this came to a head when first Bear Stearns and then Lehman Brothers went bust, and it became really obvious that the entire banking system was in very severe crisis. Governments stepped in the US, the UK, and many other OECD countries stepped in to either flat out buy debt from the banks or to guarantee their debt, or to, in other words, in some other structure, prop them up and bail them out. We weren't happy about it, but without it, the financial system may well have ground to a halt, and it would have been a very, very, very ugly situation to then unpick the mess. But the result of this was that government took this debt that originated with homeowners, ultimately threw onto government balance sheets, and of course, in many countries, that more than doubled the debt. So they're now faced with raising taxes to pay down the debt, at least service the debt, and then pay down the debt. And that means that they had to look at two elements of taxes. One is the rates that they charge, the percentage rates, and the other one is compliance. Now, percentage rates have barely moved in the last decade. Maybe 2, 3, 4, 5% in most economies against particular types of tax, but really barely moved. So it's been around tax compliance that governments have had most success and applied most pressure, making sure that people pay what they are legally mandated to pay. Now, in the US, there were some rules called the QI rules, Qualified Intermediary Rules, that meant that any American who had an account outside of the US was bound to report it to the Internal Revenue Service, the IRS, but also that that institution was also required to report it to the IRS. But the rules had no teeth, so there's very little compliance, very lax compliance with the rules, until about 2010, because in 2009 a large Swiss bank was convicted of assisting 19,000 Americans to stash a heck of a lot of money in Switzerland offshore without ever mentioning it to the IRS. This resulted in a very grumpy Congress enacting a piece of legislation called the Foreign Account Tax Compliance Act in 2010. Finally came into force in July 2014. The time in between was a measure of how difficult and complex it has been to get that piece of legislation working effectively. 55 countries have signed up to what is a series of bilateral agreements between the US and those other countries. In 4 of those cases, it's a two-way bilateral agreement, which means that while that country's financial institutions will report on Americans who have accounts there, it also means in the case of those 4 countries that the US financial institutions report on their citizens who have accounts from abroad. The 4 countries are Costa Rica, Malta, the Netherlands and UK. So if you are a tax evader from any of those 4 countries, don't stick your money in the US. Now, because FATCA had worked, was seen to have worked, had been launched, the OECD, representing all of the other major economies, looked at how they could implement something similar, and they came up with a system called the Common Reporting Standard, which is a multilateral reporting system. So rather than a series of bilateral reports, a country such as, let's take France, would report on all the citizens of the other signed up foreign countries that have financial accounts in France. And every country does that. It becomes a common reporting standard, and everyone can then see where their citizens are banking. Okay, it's a little bit brotherish, but we're talking about tax compliance here. That goes live in January 2016. Now, the issue here is that the US has determined that because FATCA is in place, it will not sign up to CRS. Now, very interestingly, the Tax Justice Network, which is a non-governmental organization that sets out to promote transparency and fairness in taxes, has just published its October 2015 report and index and ranks the US as the world's #3 tax haven, or secrecy jurisdiction as they choose to call it, right behind Switzerland and Hong Kong. It does that for a number of reasons, but not the least of which is that they consider that the US FATCA and opposition to joining CRS has put them in a position where whilst Americans abroad or Americans who have accounts outside of the country are firmly within compliance, the US does not want to imperil foreign money flowing into the US to be placed in bank accounts or stocks or any other types of financial investments. You can read the report yourself. I've linked to it through my blog and my LinkedIn page. You'll find it very interesting. The US report in particular is very detailed and very thorough, and provides a history of tax haven status of the US over the last 100 years. I hope you enjoy it, and I hope you enjoy my article, and I look forward to any feedback or comments that you have. Thank you.
Shutterstock Music.